All right, welcome to the Explainer. Today we are diving deep, and I mean forensic deep, into a really complex but super critical tax provision, Internal Revenue Code Section 86E. Look, if you're a practitioner and you have clients getting Social Security, this isn't just some optional thing to know. It's an absolute must.
Okay, so let's pop open the case file on this one. First, we're going to look at the evidence. What's the actual problem here? We're talking about income bunching. Then we'll check out the tool Congress gave us to deal with it. After that, it's time to get our hands dirty with the actual shadow calculation. And there are always hidden traps, so we'll navigate the whole MAGI Labyrinth. Finally, we'll wrap it all up with the verdict, when to use the selection and why it's so incredibly powerful.
So, where does our investigation even begin? It all starts with a trigger event. Picture this. Your client walks in, hands you their Form SSA-1099, and you see it right away. This huge retroactive lump sum payment. It's for benefits from several prior years, all paid out at once. And that one thing, usually just from some administrative delay, is about to create a massive and, frankly, a really unfair tax problem.
So what's really going on here? Well, this whole thing is what happens when our once-a-year tax system smacks right into our progressive tax brackets. It's often called the Tax Torpedo for a reason. The whole idea behind our system, vertical equity, is that people who can afford to pay more in taxes should pay more. But in this situation, it's not about their ability to pay. It's all about timing, and that's what's jacking up their tax bill. It's a total distortion.
And this chart just lays out the unfairness perfectly. Imagine your client was owed, say, $150,000 in benefits. If they got that money the right way, $50,000 a year for 3 years, their tax bill would be pretty reasonable, right? Each year, they're in a lower bracket. But what happens if they get all $150,000 in one single year? Bam! The tax hit is huge. That bunched up income shoves them way up into higher tax brackets. It's the exact same amount of money, but the tax outcome, it's worlds apart.
What's really wild is that this problem has just gotten worse and worse over the years. Way back in 1983, when benefits first became taxable, they set these income thresholds, $25K for singles, $32K for joint filers. Then, in 93, they added another higher tier. But here's the kicker. Those numbers have never been adjusted for inflation. So a lump sum that your client gets today is being slammed up against these tiny thresholds from decades ago. It just makes that whole bunching problem so much more painful. Okay, so that's the problem. Let's talk about the solution. Congress actually created a tool specifically to fix this mess, and that's what we're here to talk about, Internal Revenue Code Section 86E. The title itself tells you everything. Limitation on amount included where taxpayer receives lump sum payment.
I know, the actual language in the code is, well, it's pretty dense. But its purpose is actually crystal clear. The whole point of this section is to act as a limit. It's there to make sure that a taxpayer who gets one of these delayed lump sum payments doesn't pay a penny more in tax than they would have if the Social Security Administration had just paid them on time. It's a straight-up legislative fix for this whole timing inequity.
So let's break down the key terms here, because they really matter. First, a lump sum payment. It's not about how big the check is. It's all about when it should have been paid. The rule says the payment date was in a prior year. And the attributable amounts? The SSA-1099 just gives you those, so that's easy. But the real magic is in the phrase, shall not exceed. What does that mean? It means this whole election is an optional cap. You get to figure out the tax 2 different ways, and then you just pick the one that's lower. It's a choice.
All right, let's get into the nitty-gritty.
How do you actually do this? We're going to walk through the mechanics of what's often called the shadow calculation. And if you want to see it all in black and white, the entire process is laid out for you in IRS Publication 915.
Okay, this is really the heart of the whole forensic analysis. It's a 5-step process where you're essentially doing 2 calculations. First, you do it the normal way, the cash method. That's worksheet 1. You pretend all the money came in this year. Simple enough. Then you do the shadow calculation. You take those prior year amounts and you hypothetically plug them back into the years they belonged in. You're just figuring out what the increase in taxable benefits would have been back then. You add up all those little increases, combine them with the current year's part, and then you compare. Which number's lower, the regular way or the shadow way? You pick the lower one. That's the election. Now, this is so important. I have to say it twice. You do not go back and amend prior year tax returns. The language in Publication 915 couldn't be clearer. Don't file an amended return for the earlier year. This whole thing is a hypothetical calculation. It happens on paper, in your software for the current year's return.
All you're doing is figuring out a limit to apply to this year's tax bill. You are not changing the past.
Okay, so we've got the calculation down, but making the selection creates all these ripple effects, and this is where things get tricky, because we have to enter what I call the MAGI Labyrinth. Why a labyrinth? Because modified adjusted gross income, MAGI, isn't one single number. It's defined differently all over the tax code, and those different definitions can have huge consequences. And here's the big twist, right here on the screen. Look at the two definitions. For the ACA premium tax credit, the formula for MAGI is your AGI plus your non-taxable Social Security. They add it back in. But then look over at the formula for Medicare IRMAA. It starts with AGI, but it doesn't have that add back. That one tiny difference in the formula, it changes everything for our election. And hey, this isn't just us interpreting things. This is settled law. There was a big tax court case, Johnson versus Commissioner, that dealt with this exact question. And the court was super clear. Think about what the Section 86E election does. It makes some of your Social Security benefits non-taxable, right? Well, for the ACA premium tax credit, the law says you have to take those exact same non-taxable dollars and add them right back to get your MAGI. The bottom line, the election gives you absolutely zero help when it comes to ACA subsidies. But it is a completely different story when we talk about Medicare IRMAA and the net investment income tax. Remember how their MAGI formulas don't add back the non-taxable Social Security? Well, that means the AGI reduction you get from the election flows straight through, and that's huge. It means this election could be the very thing that keeps your client under an IRMAA threshold, saving them maybe thousands of dollars a year on their Medicare premiums. Same thing for the 3.8% net investment income tax. It could pull them right under that threshold and avoid the surtax completely. All right, let's pull all this evidence together. It's time for the final verdict and a clear game plan for you as a practitioner. This table right here, this is the whole story in a nutshell. It's the key takeaway. Look at what the election does. It lowers federal AGI, it stops you from getting pushed into higher brackets, and, this is a big one, it can help you dodge those painful Medicare IRMAA surcharges. But look closely at that neutral for ACA subsidies. That's the Johnson case right there. So yeah, this election is an incredibly powerful tool, but you have got to know exactly where it works and, just as importantly, where it doesn't. So let's leave it with this thought. Those income thresholds for taxing Social Security, they're stuck back in 1993. As inflation keeps humming along, more and more of your clients are going to get pushed over those lines. That means the sponging problem is only going to get more common and more painful. And what that means for you is that knowing the Section 8060 election, it's not some niche specialty anymore. It's becoming a core competency. So from now on, if you see a multi-year breakdown on a client's SSA-1099, that has to be an automatic mandatory trigger in your head to run this analysis. Because if you don't, you could be leaving some serious money on the table for your client.